Today, a spotlight on surfers' paradise. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. And today I want to continue my series on property price analysis with a focus on Queensland. And tonight in particular, I'm going to be looking at postcode 4215, which is right in the heart of the Gold Coast and of course includes Surfers Paradise. Now this is an important postcode because many people are saying that property prices are roaring away here and transaction volumes are very high, and this is a sign of a booming market. So let's look at the information from our surveys and other sources and try and read what's really going on. And I should just start this by saying, as I always do, this isn't financial advice. This is merely my analysis of the data that I have and the modelling that I've done. So please don't take it as financial advice because it's not. It's just my data analysis. And just to recap, for those who may have missed the story, we survey households on an ongoing basis, and we also incorporate information from a range of other sources, including from JobKeeper and JobSeeker, as well as other industry information. That goes into our core market model. That's the middle of the picture there, and that's where we crunch all the data, and that data then feeds our industry analysis, our client work, and our YouTube channel. And we have data coming through from our surveys every week, so it's bang up to date. And that means that we can use our mortgage stress data, the house price trajectory data and history, the buying and selling intentions data from our surveys, migration statistics, and economic statistics such as CPI, wages and employment, and put them into our core market model, run them through our various scenarios, and calculate at a postcode level or roll it up to a region, state or all Australia level. And it does allow us to analyse prices on the ground. And so we're talking about 4215 here, which is really right in the heart of the Gold Coast and includes places like Southport and Labrador, as well as Surfers Paradise. And of course, Surfers Paradise has these iconic pictures of very tall towers right against the sand, many beach havens surrounded by tall buildings, and even moving further away from the centre of town, you can see the towers in the background. And there are also views with less towers, but it is really hard to escape them, particularly down the coastal strip. So let's start by looking at properties for sale in the postcode 4215. And there are around 447 properties listed for sale at the moment, and here's a map. And you can see that it is really quite a concentrated area, pretty much all down the coastal strip and just back from it. And I've included some examples here of recently listed property, and interestingly, quite a few of the properties are apartments. And there is some vagueness about some of the prices. So, for example, offers over $759 for this house in Labrador, or price from, no address provided, as well as some with a firmer price. And I often say when it says offers over a set price, that's a bit of an indication of a little bit of fluidity in the market. And you can see that a lot of the stuff for sale is based on apartments rather than houses. And there's the odd one that must be sold, and others inviting buyers above a set price. And you may have noticed the term villa, which is being coined to essentially try and differentiate from a unit. A villa is a crammed-in small house, probably in a block or terrace of some sort. Turning to sold properties, there are around 159 properties sold in the last 8 weeks in the postcode. And again, you can see the distribution across the map quite a few down the coastal strip once again. It's pretty dense, of course, there, a lot of high-rise. It's pretty dense there, of course, a lot of high-rise building, a lot of units. And here are just a few. Once again, of course, it's the same old last asking price, or by negotiation, or last asking price with a price band, or even sold at an auction, but not disclosing the price sold. This is becoming more and more of an issue, trying to get to understand what prices were actually settled. Last asking price, of course, is nothing necessarily to do with the settlement price, and as we'll see later, the average settlement price tends to be below the asking price at the moment, although of course there will be the odd exception. I'd also make the point that relative to the listings, more houses than apartments are actually selling at the moment, and that may tell us something about the dynamics of the local market, as we'll see a little later. And once again, last asking price with a range doesn't really help anybody, does it? So now let's look at the current price trends, and we're going to start with Southport units. Back in 2013, the average unit was $300,000. Today, it's $350,000. And in fact, the peak of average price was back in 2015 and 2017. So prices are currently lower than their peak. And you can see that there were significant moves in 2014, 2015, a drop in 16, a small rise in 17, a small drop in 18, a significant drop in 19, and flat in 2020. And that means that the average gain between 2013 and 2020 was 2.7%, or after inflation, 0.8% per annum. So once again, no evidence here of prices doubling every 7 years. And if we look at houses in Southport, the average house price in 2013 was $420,000. Today, the average house price is $595,000. And the trajectory is quite interesting insofar that there were peaks in 2017 and 2018 of $580,000, a fall in 2019, and we're now back to peak at $595,000. And the big rises were back in 2014, 2015, 2016, a smaller rise in 17, nothing in 2018, a small fall in 2019, and a slightly bigger rise in 2020. And on average, that means that the gain between 2013 and 2020 is 4.9% per annum, or 3% per annum after inflation. But again, no evidence of prices doubling over 7 years. Let's go to Labrador then, another important part of 4215. And there, the average unit was $310,000 in 2013, and it's $360,000 in 2020. And that is actually a peak, but that same peak was reached back in 2017. So you could argue that there's been no real increase since 2017 and 2020. And the biggest lifts in prices year on year were in 2014 and 2016, but there were falls in 2015, 2018, flat in 2019, and a small rise in 2020. And that puts the average gain at 2.4% per annum, or 0.5% after inflation, and again, no doubling of prices over 7 years. Labrador houses, slightly stronger once again. Generally, the houses seem to be doing slightly better than the units. Back in 2013, the average price for a house was $385,000. Today, it's $570,000, but that is just slightly below last year's peak. And you can see there that the rises were strongest in 2014 and 2017 at 14.3 and 8.1 respectively. There were smaller rises in 2015 and 16, just over 5%. Small rise in 2019 and a fall this year of 0.9%. And that takes the average gain over the years that we're looking at from 5.5% per annum, or 3.6% per annum after inflation. And now to the one that you've all been waiting for, Surfers Paradise. And here, the average unit price was $340,000 in 2013, and today it's $390,000. And that is a peak that is just slightly higher than the previous peak in 2017. And you can see that 2017 was the peak, dropped slightly in 2018, dropped again in 2019, down 1.3 and then 1.3% each year respectively. But the strongest gain was back in 2016 at 7%, and in this year we're looking at around 4%. And houses, well, this is where some of the action is, and it's not surprising. There's quite a lot of interstate interest in houses, particularly at Surfers Paradise. And back in 2013, the average house price was $1.11 million. Today, it's $1.75 million. And if you look carefully, you can see that the strongest rises were in 2016 at 16.2%, 2018 at 15.7%, and 2019 at 12.5%. The rise this year was 5.4%, and there were falls in 2017 down 6.6% and 2014 down 1.3%. But prices are at their peak at the moment. And that effective gain over the 2013 to 2020 range is 6.5% or 4.6% per annum. So with that introduction in terms of price movements, let's just have a look at what's going on in terms of listings. There are around 900 in total, with around 220 added in the past month. In fact, there is quite a lot of stock coming onto the market. Back in May 2019, listings were higher at more than 1,000, and around 20% of properties are houses, the rest are units. And of course, that is one of the things that is very clear when you look at 4215. It's the proliferation of units, which is partly the reason why unit prices are relatively static. The gross yields on houses are sitting at around 4.1% at the moment, and that's a fall from 4.9% last year. The net yield is around 2.75% and is falling. And by the way, on a national basis, that's still not bad. Units have a higher gross yield of around 5.5%. That's a fall from 5.7% last year, and the net yield is around 3.75% and is also falling slightly. And the rents for houses at the moment are down 1.5% in the past quarter, with a typical rent of $490 a week, while rents for units are down 0.5% in the past quarter, with a typical rent of around $420 a week. Vacancy rates are sitting at around 1.5%, and that's lower compared with the 2.6% from last year. And there are around 230 vacancies currently reported, compared with 380 back in 2019, and that does include a large number of Airbnbs. Asking prices for houses are on average up about 1.5% over the last quarter, with a typical house price of $630,000, but it does vary, as we showed earlier on, and prices are significantly higher on the beachfront. The average settlement is 6% lower than the asking price. And asking prices for units are on average up around 2.5% at the moment, with a typical unit price of around $400,000. And the average settlement price is currently sitting at around 8% lower. And in fact, that settlement price relative to asking price is creating a bigger gap at the moment. Now, this is my stress data for the postcode, and there are around 25,000 households in the postcode, of which 5,500 are borrowing and around 16,500 are renting. And there are 12,500 properties for rent, and there are around 8,000 property investors in the postcode. The overall financial stress measure is 41%, which is high but not very high. Within that, there are around 1,100 households in mild mortgage stress. That equates to around 21% of those with a mortgage. And the risk of defaults is sitting at 2%, so that's around 140 households risk defaulting over the next 12 months. Now, that takes into account all of the issues with regard to principal and interest payment holidays. And we do know that a number of households will be facing difficult decisions ahead, as some banks are now starting to insist that they start to make repayments or put their property on the market. In terms of rental stress, around 36% of renters are in difficulty. That's around 6,000 renters. And around 44% of property investors are stressed at the moment. That means that they're having difficulty with cash flow or vacancies or are trying to sell. And that equates to around 3,000 stressed investors, and that includes 550 which are severely stressed. And I will just show you the mortgage stress map because 4125 registers a small amount of stress, and you can see, in fact, in this whole area, there is some stress. The higher the stress, the more yellow or orange it becomes. But mortgage stress is not as high in this area of Queensland as in many parts of Queensland or indeed the country. And so to complete this show, I'm going to take you through the scenarios. Firstly, for Southport units, well, my best case is for a rise in prices of 2.9% over the next year, followed by a smaller rise in 2022, and then a fall in 2023 to give a 3-year move of down 3.7%. In my longer-term crunch scenario, which is my base case, I'm expecting units in Southport to drop about 7% over the next year, a further 3% in 2022, and a further 7 or 8% in 2023 to give an 18.4% fall overall. And if the virus rages for longer and we get more bounce back issues with regard to infections, prices will fall further. It could fall 13% in 2021, another 7% in 2022, and another 10 or more percent to give a 33.4% fall in 2023. If I apply my mid case to the unit prices in Southport, at the moment we said they were around $350,000, so they could drop to $325,000 over the next year, another small fall to $314,000 in 2022, and a further fall to $290,000 in 2023. And if that were to eventuate, it would put prices back to where they were way before 2013. Now, if you have a more positive view of the economy, those price falls won't be so severe. If I then look at houses in Southport, and there the 3-year fall in my best case scenario is down 2.2%, the multi-wave would be down 19.7% over 3 years, and the longer term crunch will be down 11.2% over 3 years. And applying those factors to prices for houses, they're currently at $595,000, so they will drop by 4.4% to $569,000 next year, drop another 2% to $558,000 in 2022, and drop another 4.8% in 2023 to $531,000. Now, if that eventuated, it would take prices back to where they were in 2015-16. And again, if you're more bullish on the economy, prices won't fall as far. But I think you have to ask the question about international visitors because, of course, tourism is the lifeblood of the area. And whilst some interstate tourism can help, the international tourists are really required to drive the economy. And by the way, the other evidence is that international prospective interest in purchasing properties in this area is significantly down too. Let's go to Labrador then. And there, the 3-year trajectory in the best case scenario is down 3.7% for units, down 18.4% in the longer term crunch scenario, and down over 3 years 33.4% if we get a multi-wave reoccurrence of the virus. Applying my mid-case, you can see that the $360,000 price tag for units slides slightly down 7.3% to $334,000, falls again in 2022 to $323,000, and down 7.8% to $298,000 in 2023. If that were to eventuate, again, we would be seeing prices back to where they were in 2013. If I look at Labrador houses, then there is a 2.2% fall in my best case scenario over 3 years, with rises in the next 2 years. If I take the multi-wave view, then prices could drop 19.7% over 3 years. And if I take my longer term crunch, that mid scenario, which is my base case, I'm forecasting a fall for the next 3 years, which cumulatively is 11.2%. And if you apply that to the current prices, which are sitting at $570,000, then there's a 4.4% drop to $545,000 in 2021, another 2% drop to $534,000 in 2022, and a 4.8% drop to $509,000 in 2023, which would take prices back to where they were in 2017. And now to Surfers Paradise. Of course, everybody wants to know what's going to happen here. Well, in my best case scenario, units could slide around 3.5% over 3 years, with some increases this year and next year before a fall. In the multi-wave scenario where the virus comes back, we could see a third off prices by 2023. And my mid-term view, my mid-case view, is down 18.1% over 3 years, with a 7% fall next year, a 3% fall the year after, and a more substantive fall in 2023. And that would put units, which are sitting at around $390,000 at the moment, down 7% to $363,000 in 2021, down a further 3.3% to $351,000 in 2022, and down a further 7.8% to $324,000 in 2023. And finally, houses in Surfers Paradise. Well, again, we are expecting in the best case scenario slight rises over the next 2 years, followed by a small fall. In fact, over 3 years, a reduction of 2.1%. If the virus does rage for longer, then we're looking at 19.3% fall over 3 years. My mid-case, the longer-term crunch, shows a fall of 4.3% over the next year, a 2% fall in 2022, and a 4% fall in 2023, giving a total drop of 10.7% over 3 years. And that translates into the average price moving from 1.75 million currently, down 4.3% to 1.676 million, down 1.8% next year to 1.646, and down a further 4.7% to 1.569 million in 2023. So there you have it. You can see that in some areas of this particular postcode there are some moves up and prices are a little stronger, but there is no raging upside to the market here. And even in my best case scenario, I'm predicting small rises over the next couple of years and then a bit of a fall ahead. Now, you might ask, why the fall ahead? Well, it's this, that when you look at what's happening with the economy, the short-term stimulus is being removed. Households will continue to struggle with their mortgage repayments and their finances because unemployment will stay high. There will be very little growth in income. And my expectation is that international tourism will be off the agenda for quite some time. So the economic variables here relating specifically to tourism, as well as education, are significant on the downside. And it also make the point that there are a lot of small businesses here, micro businesses, 1 or 2 people in the construction sector as well as retail. And a lot of those will be, I think, under pressure, not immediately necessarily, but longer term, definitely. And that is the reason why overall my expectation is for small rises, but then some corrections. And if you think, as I do, that the economic scenarios are closer to a longer term crunch, in other words, higher unemployment for longer, despite all the government stimulus, then in fact prices are more likely to slide rather than rise. And I will just put a rider here. It is clear that there is some interstate interest in and around this area, and particularly from Victoria and New South Wales, and particularly from those living in the inner areas of Sydney and Melbourne. And I suspect that will continue. People perhaps are thinking about a change of scene, cheaper property, of course, relative to Sydney and Melbourne. But I would warn that it's unlikely that we're going to see the sorts of capital gains that we saw a few years ago. And in fact, as I showed, most of the significant gains were made some time back as interest rates were being cut further, lending standards were being reduced, and people were buying property in a competitive environment with a lot of foreign buyers and property investors. Well, remember, property investors are pretty much on the sidelines. Foreign buyers are also out of the picture. So the supply-demand disequilibrium that is underpinning this market is going to continue. And therefore, I have to contest the view of many spruikers that this is a raging bull of a market. I don't think it is. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.